banks here, and as soon as S&P goes and downgrades Italian banks, we crash down another 150 points. I mean, how much does the situation in Europe weigh on us here in the U.S.?
Well, Europe is clearly weighing on this, and the key problem when it hits the banking sector is you have to think about contagion and international funding crises. And I share your perplexion at the fact that the news about B of A was somehow less important than the news about Italy's banks, but I definitely think that adds to people's worries that there's no real way out of this right now.
And Marvin, isn't it the point, it's not just Italian banks, but how far does it go through Europe? I mean, again, we ad nauseum talk about the contagion effect, but it's not just one country that we're worried about. We just don't know how far the tentacles are in this Europe situation and how long. I mean, already, how long has this situation been going on? And we're not anywhere near resolution. So I agree with you, Matt, that a downgrade of Italian banks, could that bring the market down so much? Doesn't quite make sense. But it's what comes next. That uncertainty is what really unnerves investors. And
policymakers don't face good choices there. Or certainly they don't face choices that are going to be politically popular. Ultimately, as many have said, Europe really needs to pursue more significant fiscal and political integration in order to make this thing work, and then step up and back the banks. Without those steps, it's hard to see how this doesn't end badly someday.
Right.
And that is a very big step to push on your populaces.
Hey, so Marvin, what do you do in terms of Treasury market fixed income investment strategy at this point with Operation Twist, and the Treasury buying those longer those longer maturities and selling the shorter term duration maturities, and then with what's going on with Europe? I mean, what's the best fixed income strategy in your view? What positions are you guys taking?
Well, with respect to what I think is the best way to look at this. The Operation Twist isn't without its downside here. I mean, Treasury yields are already very low. The entire Treasury curve is now at negative real interest rates all the way out through the 30-year. There's not a tremendous amount of value at these levels. And I would also think that there's a possibility that the Treasury itself will, in some sense, undo some of Operation Twist by increasing its issuance at the long end. In which case, if you're looking for a store of value, a safe haven from the storm, then yes, treasuries are probably a good place to hide right now, but I wouldn't expect a lot of return from them. I think you really need to look at other strategies for generating return based on further disruptions in the market, further deterioration of the economic outlook. That's going to involve shorts in many places, or in our world, in distressed value investing in the capital structure. Well,
you talked about the strategies. Can you be a little bit more specific in terms of where you think people should be putting their money right now?
I definitely think that looking at outright shorts on cyclical industries and commodities still makes sense. You were displaying a chart of copper recently. Yes, it's taken quite a tumble in the last month, but I think there's still further downside there. Potentially, if disruptions in the Middle East don't occur, there's downside in oil from here. Certainly some equities have that outlook, although there's a lot of equities out there that are trading at great dividend yield, so it's hard to make a strong case against equities, frankly. But for us, we really look at value in the capital structure of middle market companies where we're able to achieve fairly significant yields that compensate us for the downside risks here.
All right, so not the big, not the small, but the mid-market. Got it. Marvin, thank you so much. Marvin Barth, he's the Chief Investment Strategist over at